Not everyone earns $100,000 plus per year, and that's okay. But regardless, everyone should have an eventual retirement, and everyone should have their shot at financial independence. And that is what I want to talk about here today in this 3-step guide on how to invest, even if you make $40,000 or below. Now, before we begin, there is a caveat. Everyone's $40,000 is different. If you have kids, it'll be different than if you don't. And if you live in the Midwest, your $40,000 will go a lot further than if you live, say, on the West Coast. But regardless, these are 3 steps that everyone can put into work in their financial futures, especially if you make $40,000 or below. So let's begin. As always, my name is Derek, and I got my degree in finance, so you don't have to. Now, the first step to this guide actually has very little to do with actual investing, and I think it's something that most people miss when they film investing videos, because most people go directly to the investing portion of their video. But before you invest $1, you have to look at your debt situation. Now, this might sound obvious, but let's actually think about it. If you have a credit card, say, with an interest rate of 20%, and let's say over the last 100 years, the stock market has returned 10%, which is actually a little bit high. But for example purposes, we'll do this. What a lot of people end up doing with their budgeting and with their monthly budgeting is they'll set money aside directly for investing, and they will set money aside directly to pay down debt. Now, the easiest way to see that this is not the correct way to do this is to start looking at interest rates as positive and negative returns. So when you have a credit card, you have a 20% negative return on that money. When you invest in, say, the stock market, you have, let's say, a 10% positive return on that money. So let's say that you have $5,000 in credit card debt, and you have $5,000 that you're ready to invest. If you invest $5,000 into the stock market and you do not pay down your credit card first, okay, you are going to have a negative return on those $5,000, even though the return on the $5,000 sitting in your brokerage account is going up 10% per year. Because a 10% return on $5,000 is $500, but a negative return of 20% on the same $5,000 of credit card debt is negative $1,000. So you're actually losing 10% total negative return per year. Now, when we look at it that way, it's easier to understand that if you have credit card debt and you have money sitting and you're ready to invest and you're watching this video, as annoying and as bad or as not the right thing that you want to hear, the fact of the matter is you should pay down your high interest debt first. If you have money sitting and you clicked on YouTube and you wanted to learn where to invest your money and you ended up on this video, this is probably not what you want to hear, but if you have credit card debt, pay that down first. It gets more interesting because of the time that we are living in, though. Here's the thing. We live in a time where interest rates are high. We are living in what's known as a high interest rate environment because the Fed is fighting inflation, which means that, for example, a mortgage right now, they're between 7 and 8%. So it's a very interesting scenario that we're living in, but if you have a mortgage, okay, and your mortgage is, you just got your mortgage, you just bought your house, and your mortgage is above 7%, there might be some consideration that you might want to pay down your mortgage instead of investing in the stock market because the interest rate that you were paying is quite high. Now, of course, there are other factors to that, right? Your mortgage, while it is high, you're also technically also making money on that property. So if you have a property that's, let's say, $250,000 and you have a 7% mortgage, but the property is increasing, the property is appreciating by more than 7%, then you are actually, which sounds interesting and weird, you're actually making a positive return on that, okay? So this is very specific to your market because every real estate market across the country is different. But if you are in a high appreciation market, you might not have to worry about that. But there are some markets that are low appreciating markets, right? Where houses do not appreciate as fast as, say, in California or New York. In those instances, you need to take the appreciation in your local market and you need to deduct it from your mortgage rate. And let's say your market only appreciates in a drastic scenario only 1%. Well, then in reality, you have a negative 6% return on the interest portion of your mortgage. So if instead you were going to invest, let's say, in bonds, which return 5%, there needs to be consideration as to whether that's a good idea or not. Okay? Now, obviously, for example, in the stock market, interest rates are compounding. So there are some, I guess, some more advanced things that we have to consider, but I want to keep this guide as simple as possible. The first step basically is to analyze your debt. And any debt that is higher than the return that you are potentially going to make in your investments, you need to consider paying those debts down first and foremost. That is step one. So out of these 3 steps, 33% of this guide has to do with getting rid of high interest debt, because that will hold back the rest of your investing. Now let's talk about considering your options. So this is step 2 to this guide. You have to consider a few things before you make your investment. One is considering your options. The other is considering your time frame, and the other is considering your personal risk tolerance, because everyone's risk tolerance is different. A lot of times, risk tolerance and time frame go hand in hand. If you are close to retirement, you have less time, right? Which means that your risk tolerance might be lower. But at the same token, you might be young and you might still have a low risk tolerance. So you need to first and foremost figure out how much risk you want to take, because obviously stocks are going to be more risky than bonds, which is going to be more risky than a high yield savings account. And in stocks, an ETF is going to be less risky than picking your own basket of stocks, right? So you have to first and foremost find your risk tolerance. Next, you have to evaluate your options. Now, 10 years ago, this might not have even been part of this guide, but because of the time that we are living in and because we are living in a high interest rate environment, there are things like high yield savings accounts that are competing directly with bond returns. High yield savings accounts right now are over 4%. Those are competing directly with other forms of investment that 10 years ago we wouldn't have even considered talking about. But now we need to consider talking about them. So consider your options. Now, without getting too advanced, there is a theory in financial theory that basically as the risk-free premium, okay, a risk-free premium is basically the rate of return on close to risk-free assets, like high-yield savings accounts and bonds, treasury bonds. High-yield savings accounts have an insurance to them, right? FDIC insured. Bonds have the backing of the federal government, so they are considered close to or near risk-free. Now, there are some financial theories and some financial models, like the capital assets pricing model, known as CAPM, which take this into account, and they actually assume that as the risk-free premium increases, the rate of return on riskier assets like stocks and bonds should also theoretically increase. And there is data that does show that the spread between the risk-free premium and the premium that you get on, for example, stocks, does increase in periods of high interest rates. But I want to keep this guide simple, and we have to realize that when you are able to get a 4 to 5% return risk-free, that is still a very possible place to park your money, especially emergency savings, which is not something that I'm going to cover in this guide. But everyone should have emergency savings. And a lot of people, a lot of financial experts say that you should have anywhere between 3 and 6 months of emergency savings. We are moving into a potential recession if the Fed cannot control interest rates and a hard landing, right? So if they cannot balance interest rates and inflation, we might end up in a hard landing scenario. That looks less and less likely every single day, but if it does happen, there is still a potential for recession. So 3 to 6 months is good on average, but some people might say you want to have 6 to 12 months of emergency expenses in your bank account. I know, I understand. A lot of people cannot even fathom having a couple months. I get it. I understand that Americans are feeling the pain of inflation. I understand that, and that savings are dwindling. I get that. But if you are able to have emergency savings, those emergency savings should not be sitting in a regular savings account, right? If you're going to hold cash, make sure your cash is getting as high of a return as possible. So when we consider our assets, high yield savings accounts are something that we need to consider because those interest rates are high on basically risk-free cash, or risk-free assets. So step one, get your debt down. Any debt that's above the expected return needs to be paid down. Two, evaluate your options, your time frame, and your risk tolerance. If you are very risk adverse and you do not want to see your money dip or go down, then potentially stocks might not be a good option for you. You want to stick to risk-free or near risk-free assets, okay? If you are less risk adverse, then stocks become a potential, real estate becomes a potential, and you might say, well, this is a video for earning less than $40,000 and still investing. You can still invest in real estate even if you do not have, say, enough to buy an investment property outright. There are things known as REITs, real estate investment trusts, which give you access to the real estate market through the stock market. So there are potentials to earn income in real estate even if you cannot purchase the real estate asset outright. So evaluate your options, right? And understand that in order of risk, we have cash, which right now is actually quite risky because of inflation, but technically you have cash, okay? Then you have federally backed bonds of all sorts and variations, okay? And then you have ETFs, which are exchange traded funds, basket of stocks, and then you have individual stocks, and usually and of course then you have angel investing, etc. But for the average person, in that order, that is your least riskiest to more risky assets, and that usually your return will increase as you move down that direction. Okay, so evaluate your options, evaluate your time frame. The younger that you are, the more you should put in stocks usually, and the older or closer that you are to retirement, the more you should move to bonds usually. Now let's talk about step 3, which is actually the investing portion of this guide. For most people, regardless of income level, diversification is key. Now, diversification just simply means diversifying your assets or not putting all your eggs in one basket. Because if you put all your eggs in one basket and that basket catches on fire, you're fucked, excuse my French. If you diversify your assets, right, and one basket catches on fire, you are less fucked because you have your money spread, okay? The easiest way to do this, especially if you are earning less than $40,000 and if you are a beginner investor, is to use ETFs. These are exchange traded funds. I understand that picking individual stocks seems catchy and seems like a fad and seems like something that might be exciting. And if you know what you're doing, it can be. But unless you understand trading and analyzing charts, as well as fundamental analysis and understanding things like discounted cash flows and understanding how to read balance sheets, how to read income statements, how to read cash flows, and how to project that into the future, unless you truly understand that, it might not be wise for you to do that with capital that you might need in the near future or for retirement. So for most people, ETFs are the way to go. Why? Well, an ETF basically takes diversification and does it for you. Now, I'm going to talk about a few ETFs that I personally own and that I like, but it is your duty to do your own due diligence and to pick the ETFs that are best for you. The majority of a portfolio should be in a market diversified ETF. So, for example, the VOO is a great beginner ETF, and no matter if you're a beginner investor or you're earning less than $40,000 and in 10 years from now you're earning tons of money, which I hope for each and every single one of you, the VOO is still a great ETF because it is well diversified and it tracks the entirety of the S&P 500, which is the entire stock market, or at least the top 500 companies in the United States. It is what we consider when we talk about the stock market. A lot of times we're talking about the S&P 500. That is great because you are diversified across 500 different assets. It'll track the overall market in general, and it'll move directly in line with the market. So the market goes up, your money goes up. The market goes down, your money goes down. But as we see through history, the market over longer periods of time, 5, 10, 15 years, the market tends to always move up. So if you have time on your hands, stocks can be a very good option, and ETFs can be a very good option to diversify. Now, there are industry-specific ETFs like the VGT, right, which tracks tech, or Noble, which tracks basically the dividend aristocrats, companies that pay high dividends and that have increased their dividends over time. But for a beginner investor or for someone who is limited on capital, your best bet is the VOO or a similar asset like the SPY, something that tracks the general stock market. Okay, there are many out there. I like the VOO, but there are many out there. What's nice about ETFs is that their fees are very low. It's known as their expense ratio. This is usually very low as compared to mutual funds or hedge funds, which most people do not have access to anyway. Okay, now let's move down the tier. Okay, let's move from stocks down to bonds. When we talk about bonds, we're talking about near risk-free assets. Okay, and we're talking usually about federally backed bonds known as treasury bonds, not necessarily company debt, which is a different side of the coin. As you approach retirement, or if your risk tolerance is lower, bonds are a great option, especially when interest rates are high, as they are now. Because when interest rates are high, bond prices are low. Because bond prices and interest rates, bond prices and interest rates are inversely correlated. Because the bond pays out a set amount. So if interest rates increase, bond prices come down to compensate. So their set payment is a higher percentage of the bond price. Okay, I don't want to get too in depth and I don't want to make this too complicated. I feel like I'm already making this too complicated for the beginner investor. So I apologize if this sounds complicated. I'm trying my best to keep this at a beginner friendly level. Okay, the point is, when interest rates are high, bond prices tend to be low. Okay, as interest rates lower, if the Fed does its job correctly and eventually inflation is under control and eventually the Fed can lower interest rates, bond prices should move up, which means that you will have appreciation as well as a high yield on your initial amount. So bonds are a very good asset right now for everyone, no matter your risk tolerance. But if you are risk adverse, bonds are a good one. And as you approach retirement, you should move more and more of your money towards bonds. Okay. Now we also have real estate. Now, since this guide is for people making $40,000 or below, real estate outright might not necessarily be your best option, regardless of what people say. Yes, you can buy real estate with very little money down. Yes, you can get, investment loans, etc. The fact of the matter is, real estate comes with expenses. If you are buying real estate as a rental or for appreciation, there will be expenses and maintenance involved. Okay, so it's a whole nother ball game. Now, instead, if you do want to invest in real estate and you do believe that real estate will continue to appreciate, which it looks like it will until we get a building supply, as supply increases, if we get a building boom, which I've talked about in previous videos. But unless that happens, real estate will most likely continue to appreciate. So if you want to take advantage of that, I would urge you to do your research into real estate investment trusts. These are not for everyone. Some of them are great. Some of them are extremely, extremely volatile. But that is a potential option because obviously purchasing real estate outright might be off the table for most. Okay. And then lastly, we need to talk about cash. As we were saying, cash right now is providing a high level of return for what is basically risk-free, a risk-free asset. The problem is inflation. Inflation is high, and that is the only reason why cash is providing a high return, because inflation is high, which means that loans that banks make are higher. If the loans that they make are higher, they can pay their depositors a higher amount. So while cash looks lucrative with these 4 and these 5% high yield savings accounts, and it is lucrative in the sense that if you have free cash floating around, it should be in one of these accounts. If not, you are literally leaving money on the table, and in reality, you are losing money because of high inflation. It should not be a primary investment vehicle because most of the time, these are still under the inflation rate or just at the inflation rate or just above the inflation rate. So in the long term, and again, in the long term, these accounts will eventually disappear because as interest rates come down and inflation comes down, these high yield savings accounts, their returns that they are paying will also, unfortunately, come down. So when we talk about cash as an investment vehicle, cash really should be there for your emergency spending, for your monthly spending, and really I want to say, and nothing else. Obviously, I understand that that is not appropriate for most people, but in reality, cash does lose money because of inflation. And whether inflation is at 6% or 3% or 2% or 1%, it is still losing money on a year-to-year basis. Okay? So try to, basically your goal for cash is to try to cover the inflation rate. If the inflation rate is 4% and there's a high yield savings account that is offering 4%, at least put your emergency funds or any cash that you have, put it in one of these FDIC insured high yield savings accounts, because they are FDIC insured. You can still withdraw your money at any time. Most of them will provide you with a debit card, etc. It is just like a bank account, but you will at least be earning some form of return on your cash, which would otherwise be losing money year over year. Those are my 3 steps. Now, I wanted to keep this as broad as possible because I understand that every single person is in a different situation. Every single one of you and every single one of us is in a different situation. Even where we live in this country, that changes how much $40,000 is. Like I said, in the Midwest, it's going to go a lot further than if you live in San Francisco, right? I think the San Francisco, what is the poverty line for San Francisco? I think like in the 80,000. It's something crazy because San Francisco is so expensive. So, but in the Midwest, it might be a lot less. So just understand that your 40,000 goes further or not as far depending on many, many variables. I wanted to keep this guide as general and as broad as I possibly could to help as many people as I possibly could without going into specifics. Now, if you want specific advice, I cannot provide that. You need to go to a financial advisor if you want specific advice on what to buy and what to sell. Okay. Now, I do urge everyone to do that. If you do not have a background in finance, take advantage of people who have backgrounds in finance. I got my degree in finance because I love this. Take advantage of someone who has their credentials. A financial planner will help you if you want specific advice. But for the general broad market, this is well thought out advice that has been put into place for decades. Lower your debt, because if your debt is costing you more than you can earn, you are losing money. You are losing money on your investments. I know that sounds weird, but if you are making 10% return on your investments, but you have a debt that is costing you 16 or 17%, and you chose to invest instead of paying off that debt, you are technically losing money. Now, I understand that investments are compounding. So over time, it grows. But credit card debt and some debts are also, in a sense, compounding, especially if they allow you to do just the minimum payment. Okay? So just remember, pay your high interest debt first. And we're in a situation where mortgages are so high that it might even make sense to pay off a mortgage first. Every single person and every single market is different, so you have to analyze your personal real estate market if you do have a mortgage, okay? Next, evaluate your time frame and your options, because there are many different investment vehicles. Most people are going to gravitate towards a majority of their portfolio in the stock market because it gives you the highest return above the risk-free premium, okay? Even then, probably for most people, stay away from investing in individual stocks. At least the majority of your portfolio should be in ETFs, okay? Something that is diversified, well diversified, okay? And thirdly, invest. Which option is best for you? Pick the option that's best for you. Invest your money. And finally, and I'm going to end this video with that, lastly, be patient, because investing, no matter what income level, no matter if you're 30, 40, 50, or 20, no matter where you are, investing takes time. Especially well thought out, long-term investing takes time. So be patient, okay? Let your money sit. Do not freak out when your money goes down or up. If you have windfall profits, don't withdraw it and buy a sports car, okay? If you have losses, don't freak out as long as your portfolio is well diversified. Those losses will 99.99999%, as close to 100% guaranteed as possible, those losses will recover over time. Obviously, nothing's 100%, but as close to that based on the data over the last 100 years, they will recover. And if they don't, we have bigger problems, because as the economy grows, the stock market always goes up. And if the stock market doesn't go up, we have problems. If the stock market doesn't go up for decades, there's some bigger issues, and I don't know if we're going to be worrying about money. Okay, so in most cases, those losses will be recovered. So be patient. I hope this guide was helpful. I hope it wasn't too confusing or too complicated. I try my absolute best when I do these guides to keep them simple. Now, we do have advanced stuff on the channel. I do have my degree in finance. I love this stuff, and I've been invested in the market. I've been following the market for the better part of a decade, and I love sharing my experiences with you guys. So if you haven't yet already, please consider subscribing. It helps the channel tremendously. And please consider turning on the bell notification, because that also helps you get the next video, which are usually on Tuesdays. Sometimes I'll do a Tuesday video and a Thursday or Friday video if there's some major news, if the Fed does something, if interest rates change, etc. If a major company files for bankruptcy, whatever. I'll usually do a secondary video, but the main content is usually on Tuesdays, and I try to keep you up to date on the economy, as well as doing guides like this to help you guys better. So again, my name is Derek, and I got my degree in finance. If you'd like to chat, please feel free to do so in the comments, as long as we keep them civil. I'm not God. I don't have a chip on my shoulder, and I understand that I am not right every single time. So if you have differing opinions, please feel free to leave them in the comments, or find me over on Instagram, just my name on Instagram, and we can have a chat on there as well. But other than that, I love you guys. I love this stuff. I love being able to share it with you guys, and I will see you in the next video.